A silent war is being fought for the soul of the Indian stock market, and billions of dollars are on the line. On the surface, it looks like just another bad day for investors. But beneath the numbers, secret signals are flashing on the charts, warnings that suggest a catastrophic collapse could be just around the corner. While foreign giants are fleeing in panic, a desperate battle is being waged to prevent a total meltdown, and millions of everyday investors are caught right in the middle, completely unaware of the danger they're in. The trading session opened not with a bang, but with a horrifying wave of red that washed over the entire market. It wasn't just a dip, it was chaos. The Nifty 50, the pulse of India's top companies, plunged by over 165 points. The broader BSE Sensex wasn't spared, plummeting more than 500 points in a brutal sell-off. Imagine billions of dollars in wealth, the savings and dreams of millions, vanishing into thin air in a matter of hours. Out of the 50 heavyweight stocks on the Nifty, a staggering 42 were in the red. It was a massacre. The pain was felt everywhere. The powerful IT sector, once the darling of investors, took a heavy blow, falling over 1%. The metal index, a backbone of industry, buckled under the pressure. Even the auto giants, from Maruti to Bajaj Auto, saw their value skid, dropping nearly a full percent. It was a domino effect of devastation, where almost no sector was safe. For anyone watching their portfolio, it was a terrifying sight. But the real story wasn't just about the numbers on the screen. It was about who was doing the selling, and why they were running for the exit so fast. The answer to that question reveals a chilling truth. The chaos was being driven by a massive foreign exodus. Foreign institutional investors, or FIIs, the global giants with trillions of dollars at their command, were dumping Indian stocks at an alarming rate. In a single day, they yanked over 1,000 crore rupees out of the system. This wasn't just profit-taking. This was a statement. This was a vote of no confidence from the biggest players in the world. So why the sudden panic? The trail leads back to the United States. As US bond yields began to rise, global money managers saw a safer, more attractive place to park their cash. The message was clear. Why risk money in a volatile emerging market like India when you can get a guaranteed return from the world's largest economy? This move sent shockwaves through the Indian market, signaling that international faith was wavering. For years, foreign investment has been the fuel for India's bull run. But now that fuel line was being cut. The giants who had propped up the market were now leading the charge for the exit door. But while the foreign titans were fleeing, a different group was making a stand. And their actions could either save the market or trap millions in a devastating bull trap. As foreign money flooded out, another force rose to meet it. Domestic institutional investors, or DIIs, India's own financial powerhouses like mutual funds and insurance companies, stepped into the ring. In a bold counter move, they bought up over 200 crore rupees worth of stocks. It was a classic tug of war, a high-stakes battle of Indian money versus the world. The DIIs were essentially building a wall, trying to absorb the relentless selling pressure from the FIIs and prevent a total market collapse. On the surface, this looks like a heroic act, a show of faith in the Indian economy. They were betting that this was a temporary panic, a golden opportunity to buy the dip while others were fearful. But there's a darker interpretation. Are they truly confident? Or are they desperately trying to prevent a panic that could spiral out of their control? By propping up the market, they might be creating a false sense of stability, luring in small, unsuspecting retail investors who see the DIIs buying and think it's safe to jump in, only to be left holding the bag if the market falls further. This is the multi-billion-dollar question. Is this a patriotic defense of the market, or the final desperate act before the dam breaks? For, as analysts dug deeper into the charts, looking past the buying and selling, they found something that sent a shiver down their spines. The market had just broken through a critical lifeline. For weeks, the Nifty had been trading above its 20-day exponential moving average, or EMA. Think of the 20-day EMA as the market's short-term pulse. As long as the index stays above this line, the bulls are considered to be in control. The trend is positive and confidence is high. It's a psychological safety net that tells traders that the upward momentum is intact. But on this day, the safety net was torn to shreds. For the first time since early October, the Nifty closed decisively below this crucial level. This wasn't just a minor dip, it was a technical breakdown, a loud and clear signal that the bullish momentum had been shattered. The bears, the sellers, who bet on the market falling, had seized control. This single event shifted the entire market sentiment from cautious optimism to outright fear. It suggested that the recent highs were no longer sustainable, and that a deeper, more painful correction was not just possible, but likely. But this was only the first warning sign. An even more sinister pattern was lurking on the charts, one with a dark history of predicting financial disasters. For seasoned traders, some patterns on a stock chart are more terrifying than any headline, and the one that just appeared on the Nifty, its daily chart, is known as the double top. This chilling omen is exactly what it sounds like. The market rallies to a high, pulls back, and then rallies again to the same high, only to fail and fall back down. It forms a shape like the letter M. Historically, this pattern is a powerful reversal signal, often marking the end of a bull run and the beginning of a brutal bear market. It signifies that the market tried to break through a certain price level twice and failed both times, showing that the buying power has been completely exhausted. The confirmation of this deadly pattern sent shockwaves through the analyst community. It suggested that the recent peak near 26 to 100 wasn't a stepping stone to new heights, but a ceiling of resistance that the market simply could not break. The appearance of the double top was like a ghost from crashes past, whispering that the party was over. Now every small rally would be viewed with suspicion, seen as a potential trap before the next leg down. The chart was no longer a picture of hope. It had become a map pointing toward a potential catastrophe. This technical breakdown wasn't happening in a vacuum. It was amplified by a rising tide of fear that was already sweeping through the market. This fear has a name: the India VIX, or the Volatility Index. It's often called the most fear gauge because it measures the market's expectation of volatility over the next 30 days. As the VIX rises, it means panic is setting in, and it was quietly creeping up. This growing anxiety wasn't just about one bad day of trading, it was fueled by a storm of uncertainty brewing on multiple fronts. The ghost of the Adani Hindenburg saga still lingered, a stark reminder of corporate governance issues that made foreign investors nervous. At the same time, geopolitical tensions across the globe were causing a flight to safety, punishing emerging markets like India. And domestically, the political landscape was adding another layer of unpredictability. Market stability is often tied to political stability, and any hint of a shake-up can send investors running for cover. All these factors, corporate scandals, global conflicts, and political jitters were creating the perfect storm. The market's fall wasn't an isolated event. It was a symptom of a much deeper instability, a crack in the foundation that was finally beginning to show. So, where does this leave the average investor? For the millions of new, everyday people who poured their life savings into the market over the last few years, this is a moment of extreme danger. They are now caught in the crossfire of a titanic battle. On one side, you have the foreign institutions, the so-called smart money, who are signaling that the risk is too high and are getting out now. On the other side, you have the domestic institutions who are confidently buying up everything, insisting that the Indian growth story is intact. Experts are just as divided. Some, like Vinod Nair, say investors should continue to buy on dips, believing this is a temporary setback. But the charts are screaming a different story. The broken support lines, the sell signals from momentum indicators, and the terrifying double top pattern all point to a market on the brink of a much deeper correction. The question every investor must now ask is a terrifying one. Is this the dip before a new surge, or is it the final warning before the floor completely gives out? The war between foreign fear and domestic hope continues, and the fate of billions of dollars hangs in the balance. For many, this will be the ultimate test of nerve, where one wrong move could be the difference between fortune and financial ruin. YouTube Content Opt.